Where should you invest in Europe in 2026? It's a huge question, and the answer often comes down to one thing: taxes. In this video, we're breaking down the tax systems and investment opportunities across the European countries. We'll look at low tax havens, markets with huge growth potential, and everything in between. Whether you're an investor, an entrepreneur, or an expert thinking about a move, this guide is for you. First, let's get a big picture view of Europe's tax landscape. The average corporate tax rate in Europe is around 21%, which is actually a bit below the global average. But that number hides a lot of variety. On one side, you have high-tax countries like France, Germany, and Portugal. On the other, you have low-tax champions like Hungary, Bulgaria, and Cyprus. These tax rates are a massive deal. They directly impact a company's profitability, where they choose to invest, and even where they set up their headquarters. So, if you're looking for the best returns, understanding this landscape is your first step. Let's start with a classic favorite, Ireland. Famous for its 12.5% corporate tax rate, it's one of the lowest in Western Europe. This has turned the country into a magnet for foreign direct investment. It's no accident that tech giants like Google, Apple, Meta, and Amazon have their European headquarters here. The combination of low taxes and an English-speaking, highly skilled workforce is just too good to pass up. For tech and holding companies looking for a new base with a low-cost structure, Ireland is a top contender. It's worth noting, though, that when you factor in things like dividend taxes, the overall picture can get a bit more complex. But for pure corporate operations, it's incredibly efficient. Now, let's travel east to Hungary, which boasts the lowest corporate tax rate in the entire European Union at just 9%. This unbelievably low rate makes it a powerhouse for manufacturing. Big players in the automotive and electronic sectors have flocked here, taking advantage of pro-investment policies while still having full access to the EU market. For any business focused on maximizing after-tax returns, especially for regional operations, Hungary is a very compelling option. The government has made it clear that it wants to attract foreign capital, and that 9% tax rate is their biggest and best sales pitch. It's a strategy that's clearly working, boosting returns and making the country a central hub in many supply chains. Next up, let's head to the Mediterranean and talk about Cyprus. For years, it's been known as a business-friendly and tax-efficient hub, with a corporate tax rate of 12.5%. But there's a big change on the horizon. Starting January 1st, 2026, Cyprus is raising its corporate tax rate to 15%. This is a significant shift, the first in over 2 decades. However, the country still offers major advantages, like exemptions on capital gains for certain assets. Its strategic location at the crossroads of Europe, Asia, and Africa, combined with a network of beneficial tax treaties, makes it ideal for regional headquarters and investment platforms. It's particularly strong in maritime services, financial services, and holding companies. Plus, for those in the digital asset space, Cyprus is becoming increasingly crypto-friendly. The tax treatment of cryptocurrencies is quite favorable, with gains often treated as capital gains, which may be tax-exempt under certain conditions, making it an emerging hub for crypto companies. Now for a country that's making some really interesting moves, Poland. They are set to launch a new tax-free investment scheme around 2026 or 2027, with something called personal investment accounts. The idea is that investments up to a certain limit will be completely tax-free, and even if you go above that limit, the gains will be taxed at a super low rate of around 0.8 to 0.9%. compared to the normal 19% capital gains tax. This is a game changer. It's designed to make investing more attractive for everyone and could supercharge investment in local real estate, the booming tech and startup ecosystems, and the country's critical manufacturing sector, which is a key part of the EU supply chain. These new tax incentives are positioning Poland as a seriously hot emerging investment destination. Let's talk about a digital pioneer, Estonia. This country has one of the smartest tax systems in the world. Here's how it works. Companies pay zero corporate tax on their profits, as long as those profits are reinvested back into the business. You only pay tax when profits are distributed to shareholders. This model is pure genius for fostering growth and innovation. It encourages companies to reinvest in themselves, fueling expansion. It is no surprise that Estonia is a global leader in the digital economy and a hub for startups. Combined with its famous e-residency program, which allows anyone in the world to start and manage an EU-based company online. Estonia is a dream for tech entrepreneurs and software companies looking to scale quickly.
Of course, we can't ignore the big players.
Let's look at France.
As one of Europe's largest economies, it naturally attracts a lot of investment.
However, the tax environment is much tougher. France has a higher integrated tax burden overall, and the 2026 budget is expected to include some tax hikes alongside some targeted reductions for businesses.
So, why do people still invest in France?
Because it dominates in key strategic sectors.
We're talking about luxury goods manufacturing, aerospace and defense, and increasingly, the green energy and electric vehicle supply chains.
While the higher taxes require very careful financial planning, the sheer scale and strength of these industries mean France remains a top-tier destination for strategic, long-term capital.
You just need to know what you're getting into.
Beyond corporate taxes, what about personal investors? A huge factor here is capital gains tax. This is the tax you pay on the profit from selling an asset like stocks. The rates vary wildly across Europe. Some countries are incredibly friendly to investors. In Slovenia and Switzerland, for example, you can pay zero capital gains tax on certain assets, which is a massive incentive for long-term holding. On the flip side, countries like Denmark and Norway have some of the highest rates, where personal income and capital gains are taxed heavily.
This directly impacts your portfolio returns and how you plan for retirement. So choosing a country with a favorable capital gains tax regime can make a world of difference to your final net worth.
So, pulling it all together, what are the top investment themes for Europe in 2026?
First, green energy and sustainability are massive. With regulations like the EU's Carbon Border Adjustment Mechanism, money is pouring into renewables and clean tech. Second, technology and digital transformation continue to boom, with hubs like Ireland and Estonia leading the charge. Third, we're seeing a manufacturing resurgence as companies shift supply chains closer to home. Countries like Poland and Hungary are perfectly positioned to benefit from this trend. Finally, classic investments like infrastructure and real estate remain solid bets, especially in stable, large economies like Germany and France, which continue to attract institutional capital.
Europe's investment landscape is incredibly diverse. From the low-tax havens of Hungary and Ireland to the digital-first model of Estonia and the new incentives in Poland, there are opportunities everywhere. The key is to match your investment strategy with the right tax environment. Understanding these differences is your first step toward making smarter, more profitable decisions in the European market. Thanks so much for watching.
If you found this guide helpful, please hit that like button and subscribe for more insights into global finance and investment.
Let me know in the comments which country you're most interested in. See you in the next video.